now for us to talk about earnings. Software company iGate posted tepid first quarter results. Net income rose 26% sequentially, but it was still short of estimates as clients delayed their budgets and the company booked costs related to the Putney acquisition. Revenues for iGate down 6% quarter on quarter to $75 million. Panish Murthy, the CEO of iGate, joins us now exclusively here on CNBC TV 18. Panish, many thanks for joining us. Let me start talking to you about revenues. While they have beaten street estimates, net profit has come in flat on a sequential basis. You have said that clients have sort of held back on their decision making, and also the fact that the management's bandwidth has been focused on the Putney acquisition, which seems to have exacerbated the problem. But going forward, what are the indications that you are picking up in terms of client spending and decision making?
I think largely in the financial services space, what has happened is that most of the companies have increased their profits in 2010 on the back of efficiency improvements rather than on volume increases or revenue increases. And since we have, iGate has been largely exposed to financial services in the past, we are seeing a not that robust return of spending and a flow of projects as we had seen last year. And some of the projects started much later than last year. Last year we actually saw projects starting in December and January, whereas this time we start seeing projects starting in March, April. So that's, I think, one of the challenges. But we were able to actually acquire 4 very new marquee customers in the Fortune 500 segment. So to that extent, we are not seeing any systemic delay in decision making or anything like that. And we expect sequential growth to be there from Q2 onwards.
All right, you are expecting sequential growth from Q2 onwards, but let me talk to you about your margin scenario, because analysts were really expecting a decline in margins. Margins have come in flat on a sequential basis, dipped on a year-on-year basis. What is the outlook in terms of your margin performance? Do you expect the margins to continue to be muted as well?
I think our margins, we've always articulated that we would like to be roughly at around the 40-41% gross margin and about 25% EBITDA, 20% operating margin level. That's a stated philosophy. We are right around there. We had a fairly large acquisition-related expenses. We booked $9.7 million of acquisition-related expenses in this quarter. And in addition, there's a total of about $47 million of acquisition expenses. 32 or $33 million of those expenses will be capitalized over 5 years over the period of a loan. Then the balance, we booked some $3.5 million in Q4, $9.7 million in Q1, and we'll book another $3 to $4 million in Q2. So the acquisition-related expenses are really what has caused that. But otherwise, our margins, if you look at our margins on a adjusted basis without the acquisition-related expenses, they've been rising very robustly.
Okay, so can you give us an indication of the kind of expansion in margins that you do anticipate once the acquisition is over and done with?
Currently, currently Putney is roughly 600 basis points lower than us in gross margin and in EBITDA. And our goal in 2 years is to get the combined company up to 40-41% gross margin and 25% EBITDA.
All right. Just a quick word, if you can share with us, Panish, on the bond issue, because I understand that you raised about $770 million via the bonds issue. Can you take us through the tenure as far as this issue is concerned, and also who the book runners are?
Yeah. We actually had to take a multi-pronged strategy to raise the capital for this transaction. We needed roughly $1.25 billion to complete the buyout of the primary stockholders in Putney and the 20% MTO. The 20% MTO has been completed. We have completed that MTO process. The mandatory tender offer process has been done. So the total need for funds was actually $1.25 billion. The way we have funded that is through a high-yield bond of $770 million at a 9% coupon, which was book run by Jefferies and RBC, Jefferies and Royal Bank of Canada. And the choice, and then in addition to that, we have got $330 million of mezzanine equity debt kind of a model, which is a convertible preferred instrument from Apex, which out of which 210 was actually collected last quarter.
Okay.
So essentially the 770 million plus the 330 takes us to 1.1, and then the balance which we used was cash from our balance sheet. So that's how we actually made up the money for this. On a post-tax basis, we found this to be the most efficient form for capital raising for ourselves because we have raised the debt and the capital from the U.S. company. And therefore, on a post-tax basis, we actually found this to be the most efficient route for us.
Right, quick word, Phaneesh, then on the management transition of the combined Patni iGate entity. When are you going to announce that? Are you going to be the CEO of the combined entity as well? And if you can take us through also what the picture really looks like in terms of you offloading, if at all, stake, because your shareholding would go up to about 80%. Would you look at bringing it down to about 75%? And there has been a lot of speculation on a possible delisting eventually. Is that on the cards as well?
Well, I think the transaction is expected to close next week. So we will be announcing, a lot of the integration related models and management changes and things like that next week. So that's as part of the closure, we'll be announcing that. On the 80% to 75%, I think that's pretty much a norm that we do need to get down to that level at some point of time. We have some time to do that, so we have some flexibility, and we probably have different models to try and achieve that. On the delisting of Patni, I don't think we have taken any decision yet. We do believe that we still have all options open. I think we are firmly of the view that we would long term not like to operate two separate public companies. It creates certain inefficiencies. We lose some of the integration benefits that we could otherwise have got with one single consolidated company. But which one will be the primary listing, which one will be the secondary listing, where it will be, all of that I think is quite open. And we still have to go through a formal process for regulatory approvals and so on and so forth. So I think that's not yet on the cards at all.
That's understandable, but if you can just give us some indicative timeline by when you think you will be able to make those decisions.
I think we will progress down, we are exploring different paths to try and do this. So my sense is that it's not a question of making a decision quickly. There are certain preferred options for us. There are certain paths that we would like to go down. And if we can get regulatory approvals for those paths, then that's when it will be. So we have kind of like a plan A, a plan B, a plan C, based on which ones work for us in what we consider the most efficient manner.
All right, Phaneesh Murthy, we'll leave you there. Thanks very much for joining us on CNBC TV 18, and we wish you the very best of luck for the next quarter.